All right, all right, all right. Well, welcome back to Finance Fridays. This week we have some pretty interesting conversations over some headlines we've seen. So I'll start there. And by the way, guys, what great to get back together again and have this conversation.
It
This
is
has been a
great to
lot of
be
fun.
here. Well, especially given the fact that it's Friday, so I'm pretty excited.
It's Friday.
Friday.
Yay! Friday. All right. So adding this article that came out from CNBC, and I think it was February 5th that came out, that layoffs in January were the highest to a start a year since 2009, Challenger says. So wild because that points us all back to that time where the mortgage industry and the housing market was collapsing. So kind of a scary headline, and
Yep.
I think a lot to unpack there. I think we start with
What is Challenger?
what is Challenger, Connor?
Yeah, I mean, it's basically a company that just looks at different information. They pull reports from all over, government, private sources, and just report various things. But in this case, they report usually just large companies, Amazon, Chevron, Intel, companies like that about the layoffs. So it's pretty significant. But they don't necessarily count small business though. But still, it's a scary headline.
Yeah, it is a scary headline. So it says U.S. employers announced 108,435 layoffs for the month, up 118% from the
Yeah.
same period a year ago, and 205% from December 2025. That total marked the highest since for any January since 2009. Interesting, right?
Yep.
And then it says at the same time, companies announced just 5,306 new hires, and also the lowest since January 2009. So what do you guys think about that?
When you hear since 2009, you remember what happened in 2009.
Mhm.
And what that, I guess, makes it appear is that we're entering back into what happened in 2009. That's what it's, trying to give that appearance of. And it's giving fear to the home buyers. It's giving fear to the homeowners because as they enter into the home buying market or into real estate, that fear of, am I going to lose my job? What the security, right? Everybody wants security. That's why they enter into home ownership. And this doesn't give them that security. This headline is not friendly at all.
No. And I think we all probably know somebody that's been laid off recently, right? So when it starts hitting close to home, I think Isabel knows a few people just in her general circle that have been laid off recently. And when that starts hitting close to home, it like throws gas on that fear. So you see the headline, somebody that it happened to, and now that panic starts to set in. Like, what does this really mean? And that's where the data comes in and kind of helps us unpack it all. And I think we're kind of lucky here because we have a little bit of a data geek on our team who his favorite thing to do is review charts. And although we're all very knowledgeable about it as well, this is his jam. And so we're going to go through some of those charts and talk about what it means historically, what it means for you if you're buying a house today, what it means to you if you're a realtor and trying to help home buyers navigate this with headlines like this out.
Yeah.
The other one
before we go to that thing, real quick, if I can, I just want to say that, think about what the media does. The fact that they put out these headlines, they're not in the business to say, hey, everything's okay. Looking pretty decent. It's either it's really good or it's really bad.
The sky's falling.
The sky's falling. Because they're trying to sell information and they're trying to sell clicks and looks, and that's what they're doing here. Whether or not they actually understand the information that they put out, I don't know. But this is not 100% accurate. And that's why, we have to go through this and kind of tell people what's really going on.
Well, and I think it's fair to say that even people that are in the business, whether you're, a mortgage loan officer or you're a realtor, depending on your years in the business, your level of expertise, if you don't dive into this data, you can be misled very easily. And it doesn't matter what you do for a living. There's a lot of clickbait headlines. So unpacking and critically thinking through what you're reading is super important. The other one we have up on the screen, let me see if I can I'm still trying to figure out this tech thing. But we also have this coming out of LinkedIn where it says, U.S. added 130 jobs in January, doubling prior estimates. The U.S. added 130 jobs in January, the Bureau of Labor Statistics revealed Wednesday. Economists expected gains of less than half that number. The overall unemployment rate ticked down to 4.3% for the month from 4.4 in December. Healthcare, and I think that's a key word here, healthcare and construction saw the biggest growth. I'm sorry, say gross, but they were just 2 of 7 surveyed sectors. So lots to unpack there with the data, right? So we're going to dive into the data now, and I'm going to share a couple of charts. And Connor will kind of go over the chart, and then we're going to have a meaningful conversation of what this really means to all of us. Let's do it. I just have to figure out how to do it. There we go. Adding to the stage, we have the BLS that came out. This one was May of 25.
Yeah, that was kind of older. I mean, the reason why I wanted to show this chart is just because it talks about the revisions that they do. And so getting back to that other slide, you don't have to go back to it. But, the market was expecting 70-something thousand. I forgot what the exact number was. It came out 130,000 new jobs. So double expectations from what they thought, almost double.
Can we pause for a minute? Time out. Yeah. So like, I always make a joke that BLS stands for big ladies like sandwiches, but I don't really think that's what it means. So
no, and I don't think a lot of the traditional buyer or even renters know what this means. They just see job reports. So if someone can explain it, we know what it means, but
yeah. So for the listeners, BLS stands for Bureau of Labor Statistics.
Yeah, sorry about that.
So
I was jumping right into the data.
Boom, there it is.
So basically what they do is that the BLS, they come out with information every month and just talk about the labor market, about what jobs have done, how many jobs have been added to the economy. So that most recent report that you just mentioned, they said they came out with 130,000 new jobs versus 70-something thousand expectations, double or almost double the expectation. So that would be a positive for the economy, but a negative for rates, because the bond market and interest rates don't like strong job growth, because that could mean higher inflation, higher rates. But what does that information mean, and is it accurate? So basically what this shows, it shows that the revision that the BLS has to jobs data when it comes out. So I'll go through this real quick, but just take a look at January of 2025, that first line there. So what they do is they come out with initial data. Then like the next month or 2 months after that, they'll come out with a revision to that original data. So you can see the first number they came out with was 143,000 new jobs created in January of 2025. The second revision, they revised it down to 125. Third revision, 111. February, yes.
I got a question. Sorry. So for those listening, why are they revising it? Because if they have data, why are they revising it here?
Well, you got to think about the fact that, they do surveys of all these different companies out there, but I mean, our nation is massive. It's huge. So they can't survey everyone. They can't even survey, half of them or a quarter of them. So what do? They survey a sample of businesses in the nation, but then they have a economic model that tells them, based on their growth of the economy, population change, births, deaths, all this stuff, immigration, what do they think in terms of job creation for a specific time period? What they do is once they get actual data a month or two later, they'll revise that original number up or down based on the new number that they have, that, supposedly better numbers. But the scary thing about it is, you can see here in the chart that we have a first revision, or the original number, a second revision, and then we have a third revision. Yeah. And basically the numbers in red, like the far right in January, it basically says from the first or the original announcement of the jobs that were created to the third revision, you had a decrease in 32,000 jobs. Down in February, it was 49,000. Yep.
I have a question. So when we're looking at these numbers, this is obviously like job growth. Why don't they compare like the layoffs to the job growth at the same time?
Well, they do, and they should. I mean, they take a lot of stuff into account. I mean, I don't have the full inputs for all the models that they use, but they look at a lot of different data, but they rely heavily on their algorithms that they come up with to calculate all this information. But in simple terms, or layman terms, it's basically a guess.
That's
your
what I was
best
about to
guess.
say. In layman
Yeah,
terms, it's an educated guess.
it is.
And then as the data becomes available, they revise that
Yeah, they
guess.
revise. So the whole point of this, and kind of getting back to that $130,000 print that we talked about of new jobs being created, which was double expectation, rates actually dropped on that news, even though job growth was higher than expected. Because and you can sit back and you go, well, why is that the case? Because if the job growth is higher, that means inflation would typically be higher. That means rates should go higher, but they didn't. They dropped. So
Because it's already baked in, and they know that the data is going to be revised downward.
yeah, not necessarily. I mean, because that should happen every time, but it doesn't. And this chart here is, but it's actually good you said that, because basically what this is showing, you see the reductions over there in the actual jobs that were created, 32,000, the far right in red. February down 49,000, down 108,000. So you can see where it says the after initial release. Basically what that means is that when they came out with initial job growth number, the market in terms of price action decreased. Okay. So yeah, it basically, most people trade off the initial number, not the revision. That's what's so frustrating about this. So you have to keep in mind that any number that they come out with is going to be subject to revision, and the job growth is most likely going to be revised significantly lower, as we see
So
in this case.
if I'm break in and say, if I'm a buyer, and when I said it's baked in, we hear all these headlines, right? And the headlines are like the investors react, or the bond market trades sideways because of X, Y, or Z report comes out, right?
Yeah.
We hear
Yeah.
that all the time. But as a buyer, if I'm not a financial advisor, or I'm not in markets, I might not know what that really means. And I think that's important for people that are listening, because when we're bouncing, when rates are changing every single day, what's fueling those changes is reports just like the BLS, right?
Yeah.
And so what the investors' appetite is for that, or their reaction to that data, is what swings those small changes up and down in the bond market every single day. And so, this is kind of going off onto a tear here, but I get 100 calls a week that say, "What's your rate today?"
Yeah.
Right? What's your rate today? And
So
here's
do you ever hear anything about people worried about the economy and about job growth, or you
never.
don't? No. It's
Never.
always about rates.
No, they just want to know what your rate today is. And I
Yeah,
think it's
okay.
so wildly important for people that are listening that might be buying a home. The rates change every single day, and
Yeah.
sometimes multiple times a
Multiple
day,
times.
based off of this data.
Mhm.
And so if you are shopping for a home loan and you go to company A on Monday and you get a rate quote, and then you go to company B on Wednesday and get a rate quote, depending on what happened between Monday and Wednesday, could really swing the difference in what that rate is.
Mhm.
And so
Yeah.
you're not comparing an apple to an apple, you're
Mhm.
comparing an apple to an orange.
Yeah.
So if you're rate shopping, you really have to do it same time, same day, in the same time frame, and you have to understand what's happening in the market that's driving small changes
Mhm.
between one company to the next. And I know I just went down a whole rabbit hole, but I think it's so important, because people that are shopping for mortgage loans don't necessarily know what's happening in the background that's driving those changes.
And that's a good point, because I did have that conversation with a few people this past week, or it was about this week and the week prior, because remember, there was all that talk about the government shutdown, and that drove rates up just because the fear, right? Everybody got nervous. So they kind of, it brought the rates up a little bit. And when a client went to shop rates, it was a week after this had happened. And of course, rates had kind of came right back to where they were. And they were like, well, they're cheaper. And I said, well, let's compare it. Let us quote it today so we can show you this was from a week and a half ago. That's when that talk was happening. So it's you're right. They need to understand how things are affecting the other, because the Article 1 said there was a ton of layoffs. Article 2 is saying that there's a bunch of job hires. So in this case, is the labor market balancing out?
Yeah.
So
I think the most important takeaway from this chart is that, no matter what people that are watching this see in the headline about layoffs or job growth, or the numbers come out stronger than expected, or estimates of fourth quarter economic growth or 3%, which is way above recessionary levels. Just look at this chart and you could see that even if the numbers come out strong initially, that they revise them down almost every time. They have, for almost every month last year, revised it lower. What does that mean for us in real estate and with regard to rates? Slower growth, slower job growth is actually good for us and good for our market and good for rates. And that's one of the reasons why rates have gone from 7.25% last year in January down to 6% now, because of this very thing right here. Job growth is not as strong as they say it is. Our economy is weaker, but it's not going into recession. That is ultimately very good for us.
And that part too, like those headlines, and I love the headlines. That's why the whole concept of this was take headlines and talk about them, right? And unpack them. But you get the headline when you get some bad data for a week. Mortgage rates the highest in 15 weeks. And so somebody sees that, and I'm not saying that's a headline today, but somebody sees that and goes, okay, this week isn't the time to buy a house. Like, oh gosh. And they don't understand that maybe it's, a little, a few basis points different than it was last week or the week before. So understanding the headline and then diving into it is really important. Going over to, I'm going to put the ADP report up now, and let's talk through that.
Okay. So this is another measure of employment growth. ADP, and to be honest, I don't even know what it stands for. It's kind of like a paychecks company. That's another company that does payroll processing of company checks. So this number is much more accurate. It's subject to revision also, but nowhere near to the extent that the BLS number is. What they measure and how they measure it is actual number of paychecks going out to employees. So if somebody loses their job, they get laid off, they get fired, they no longer get a paycheck, that's going to be removed from this number. If you hire somebody, you have a brand new paycheck going out to the employee, that's going to be counted. So it's very, very accurate. So anyway, what this shows is that at the top there, 22,000 jobs were created versus a 48,000 estimate. This is actually last month. January of 26, so very recent. Less than half, or about half, of the number of jobs were created than they thought. So if you look at by business sides, none were created in small business, 41,000 in medium-sized business, which is pretty decent. But 18,000 large companies laid off employees. 18,000 people lost their jobs at large companies. But if you look at the makeup of what percent of the economy is represented by small business, it's about 2/3. So that means most of the economy didn't create any jobs whatsoever. So again, the economy is slow. And that's why we saw that revision on the last chart down in the number of jobs that were created. It's by sector. Question, anyone?
No, I was just going to say that small business represents the majority of the economy. So, and that's a big deal to see no increase in employment in that sector.
And Isabel, you had something?
Oh, sorry, go ahead.
Yeah. So since I'm giving definitions today, ADP stands for automatic data processing.
Oh, that's right.
Bringing it home. Automatic data processing.
Thanks for educating me. Yeah, I totally forgot what it's good for.
You know what's funny is that we live in a world of acronyms in the mortgage industry. So that's just another one that we need to know.
That's their payroll platform that a lot of companies use. Well, my question, I mean, more of maybe a historical trend, right? So this came out in January. And isn't it common that towards the end of the year, there's always usually layoffs around the holidays? So is this out of the norm?
No, it's been trending down for the last 6 to 8 months. And that's another reason why we've seen rates go from 7.25 last year down to 6. It's been kind of a slow grind down. I mean, the economy is actually pretty decent. We're not in recessionary levels. I mean, overall economic growth of the U.S. is still positive. So it's not horrible, but it's getting slower, which is, again, the takeaway for everyone in our business. It's a perfect environment for what we do. The economy is slowing, but people aren't losing their jobs en masse. The economy is still decent. Rates are slowly drifting down. So it's a perfect environment for us in the real estate business and for buyers also.
And I think too, when you're looking at the chart, you're going, when you look at the by sector, that's also telling, because you're adding education and healthcare obviously are the place that jobs are always created.
Yeah, they're not economically sensitive at all. Yeah. No. We can have those jobs regardless. I mean, if you have a growth in the economy, you've got to add those types of jobs.
So when you see plus 74K there, but negative 57K, that's kind of telling that Yeah, it's a bit. It's very telling. So
Yep.
that's kind of one of those things that, if I'm just Susie Homemaker, or I'm Johnny Smith that's buying a house and I see this report, if I'm not accustomed to diving through this information, that doesn't jump off a page at me.
No.
Because I'm not thinking through what that really means. And so as you see these reports come out, be sure to look at the data and kind of dig into that, because that's something you want to pay attention to.
Yep.
Yeah, I was just going to say that even though there are some layoffs, you can see the difference that it's certain sectors. It's not everything as a collective. So although there's some layoffs, the demand of the housing demand, it seems like it may stay steady. So whether there's job losses are isolated or broad-based, I think the labor market is pretty mixed. It's not collapsing.
No, definitely not.
Definitely not. So now we're going over to the other chart that we really thought was interesting, which was the recessions and peak unemployment. And I think this one is wildly telling. I love this chart.
Yeah, it's kind of interesting. You look at the different recessions that we had. 1980 unemployment was 7.8%. It went up to 10.8%. The next recession, 7.8, 6.3. Housing crisis was 10%, which is pretty bad. Think about how bad that was. COVID, we had a complete shutdown of the economy. People stayed home. People lost their jobs. Small businesses got just crushed. They couldn't even open their stores.
Time out, right?
7%.
Time out right there for 1 second, because I just want to go back to the initial thing that we looked at, which was layoffs in January were the highest to start since 2009, Challenger says, right? So now let's go and isolate this 10% a peak unemployment rate. And then does anybody know what the unemployment? Of course, everybody knows on this call. I don't even know why I'm saying it that way. If for our listeners, the unemployment rate today is 4.3%, right?
We're nowhere near 2000.
No. So that headline goes, ooh, and then you're like,
gosh.
Yeah.
I can't stand the
Well,
headline.
they're trying to sell clicks and trying to get people to kind of read what they put out there. So but yeah, I mean, and again, that's kind of what I'm talking about. You look at these numbers and yes, it's weak. Yes, they have the BLS reductions and new jobs that are created, revisions. ADP numbers weak, but still unemployment is only at 4.3% versus look at where it was in past recessions. So it's still a decent economy. It's still relatively strong, and it's definitely strong compared to past recessions. So again, a great environment for people that are looking to buy a house because the economy is still chugging along.
And well, now let's bring that back home for buyers. What's happening in the market? And I know Isabel's had a few this week. I know Shay, you as well, where our buyers are getting opportunities to negotiate things, right? Yeah. Seller concessions. And Isabel, I think you have one right now where the buyer was able to negotiate a 20% better price off list, plus a whole truckload of concessions. So that's big.
Yeah, they have the room to negotiate, kind of take a little time, breathing room there. But definitely an advantage for the buyers right now.
Yeah, huge.
So I think when we're talking to our buyers, what should they be focusing on? Is it these headlines? Obviously, we've already debunked we're nowhere near 2009. Or maybe they should be focusing on, do I have stable income? And I'm not, they may not be in those different sectors that are losing their jobs. Do I have cash reserves? Or do I have ability to get gifts? Or can I take advantage of these seller concessions? What's their long-term plan? Those are the things they should be focusing on. So if their job is stable, they have emergency savings, if they plan to stay in the home for several years, the short-term economic noise, it doesn't matter. Like it's just less, it's noise. So housing is definitely a long-term decision, and headlines are short-term. And I think for those first-time home buyers, that's what I think, and Isabel and I work a lot with the first-time home buyers, and that's what they need to see, so.
Yep.
Yeah, no, 100%. So moving to our last chart,
but not least.
Last but not least is what this means for today.
Yeah. So yeah, this is pretty awesome because like we talked about, unemployment now is at 4.3%. You can see the top row there. What happens with rates at various levels of unemployment. So when it's between 4 or 5%, you can see stable to slightly volatile, which is kind of what's happening now. I mean, rates have been on the decline because unemployment's not the only input to rates. I mean, you've got inflation, you've got all kinds of stuff, but it's a big determinant whether or not people have jobs and what the economy's doing. But it has been volatile. You think about, we were at 7.25 last year. It dipped down to 6. It went back up to 6.5. Now it's back down to 6. It's kind of all over the place, but it's stuck in this range between 6 and 7% for a long time. And that's exactly what this chart is telling us. It's going to be kind of volatile. But when it gets, 6 to 7% unemployment, downward pressure begins, because that means that the economy is really beginning to slow. When you get into that really strong recession type unemployment of 8 and 10%, significant downward pressure. I mean, that probably means rates are going to drop down to 5%, if not 4.5 to 5%, something like that. 10+%. That is a deep recession. That
we
is
saw that during COVID, right?
Yeah, that was during COVID. I mean, that you almost have to kind of kick that out of the data, just because, I mean, that wasn't a true recession. I mean, that was a forced recession because forced lockdown.
I'm going to flip back over to that screen just real quick.
So it was short. I mean, it was one of the shortest recessions we ever had, if you can truly call it that. But yeah, that's when rates take a significant dive, because there's zero growth in the economy. People are losing their jobs left and right. That is not a really good market for us, because people don't have jobs. They're worried about their income. They're not going to make big purchases. But 4.3% unemployment today versus 14.7, not even close, not even remotely close.
So, Rob, bringing this all the way home, what it means to a buyer today is you're in like a sweet spot.
Yeah. I basically call it. I think I said this before, but I basically call it the Goldilocks economy. I mean, it's,
of course, you do.
Like, yeah, you like that? You guys never heard of that?
No. But all I think of
Goldilocks.
We've heard of Goldilocks. Okay. It's just you saying Goldilocks that makes us all giggle.
I'm thinking like Pippi Longstocking. Like,
that's actually a Wall Street term. People use that all the time on CNBC.
Oh, so sorry, it wasn't part of Wall Street.
I mean, come on. So anyway, so we're not in an environment where we have super strong growth with high inflation, high rates. We're not in a situation where people are concerned about their jobs, massive layoffs and high unemployment. So it's a perfect Goldilocks situation.
Yeah. Boom.
There you go. Mic drop.
And I think the really interesting part, and no commercial at the end of this, but a commercial. Between the four of us on the call, we cover most of the state. We're from East Coast to West Coast. We have bilingual loan officers. So if some of this information you're curious about it, or you just want to have a conversation, whether you're a realtor or you are a buyer or somebody thinking about entering the market, any one of us is available to take that call and guide you through some of these headlines or guide you through your next steps. We've got years of experience and over 3,000 5-star reviews. So we're here to help any way we can. Yep. And I know everybody's excited to see where this lands. There's been a lot of pent up demand. One of the things you guys have heard me say a lot over the past couple of years is I feel bad because I have to tell more people no than yes because of affordability. Mm-hmm. And as we start to see these rates trickle down and these home prices come down with it, it's opening up an opportunity for people to get in the market that couldn't a year ago or couldn't 2 years ago. And right now is the time because they're also able to get in, but they're also still able to negotiate those seller concessions. They're able to negotiate those better prices. As we start to see rates continue to come down, we're going to get a little more activity, and that's going to spark competition, and we're going to start to see things change a little. So right now is the time.
Yep.
Absolutely.
100%.
I agree.
All right. Well, until next Friday when we get to pick on Connor.
That's okay. I can take it.
This poor guy surrounded by all these women, and we just love to beat him up daily. All right, guys. Have a great weekend, and we look forward to seeing you guys next week. Bye.
All right. See you guys.